Hi, this is Randy Finney with Right Side of the Chart, and today is Thursday, August 22nd, 2019. In this video, I'll start out with a very quick update of the markets. There's not a lot of new to report there, but we'll do a quick update. And then I wanted to go over some sentiment indicators today. A couple days ago, I went through some of my favorite breadth indicators, market breadth. Looking at the internals, that's one component of technical analysis, other than what we're looking at here: price action, volume, divergences, things like that. And then another subset, if you will, of technical analysis is looking at sentiment. So I'll go through. I don't have a lot. This video will be shorter because I only have a handful I'm going to cover today in that. And so let's just start out with an update, since I probably might not be able to get one out until after the close today. Not that I couldn't get one out, there's just not a lot new to report. Let me mark up some tools down here. Give me one sec. Okay, all right, I needed to load some drawing tools. So the battle for 294 on SPY and what was it on QQQ 189, that continues. Surprisingly, another day there. It's amazing, but it just goes to show how important a technical level. Let me get rid of this little fib right there. That's it. I mean, look at this. You just can't make this stuff up. QQQ popped up, hit a high of 293.93. It continues. Or I should say SPY did. SPY continues, as does QQQ, to respect those very important resistance levels. Still anybody's game, because until we break at the bottom or the zone or the top, like I said, it's anybody's game. We're in a sideways trading range. It leads to frustrating trades if you're not patient when you get caught up in these. I've backed off on my short-term day trade analysis at this point because we're coiling here. The big moves, the day trading ops were more in here. We had some nice trends, small trends in the 1 and 5 minute chart, trend line breaks. But lately we've really been compressing. So as you can see, it's boxed in there. We're in an even smaller trading range for the last 4 days. And so there it is. Whereas QQQ went up yesterday, made another test of the 189 level. Today, we finally had SPY come up for one more full test of the 294 level. So let's look at QQQ. There it is. Remember, daily chart, doesn't matter what happens intraday. These little skinny parts, they're called the candlestick shadow. When they're up top, you can call it a wick as well, just like a candlestick wick. It is a candlestick wick. But you got smacked back down, so it could fail to hold that level. 189 is just a brick wall right now. If they break the brick wall, obviously it's bullish, especially if they, solid daily close and they can build on it. If it proves to be a false breakout, if it happens, we'll address it at the time. Wouldn't surprise me if that is what happens. But again, you can just see this price compression here, failing so far to get through that level. So, to be continued. I just want to do that quick update. All right, I'll do futures as well. I'll do an update later today at the close. We hit that level and reversed pretty sharply earlier, regained a lot of the drop. You can see here that's when QQQ tried to pop 189, couldn't hold it, and then this is what happens: a failure at resistance or a failed breakout. You get the impulsive selling, push back up, and look, we're up or down a quarter point. So really nothing right now very technically significant to report. So now let's talk sentiment. A member in the trading room posted this, which, by the way, welcome, encourage posts, other, whether it's your own analysis, your own thoughts, charts on the market, or somebody else's, as long as you give that person credit. So somebody did. They posted a link to this person's Twitter feed. Sentiment Trader. I don't know who that is. I guess this is a Twitter handle. Whether it's whether they operate a service as well, I don't know. But by the name, obviously, that should be their area of expertise, Sentiment Trader. So what they put in is here, and a good point, because I do follow these things. I haven't posted anything in a while, but I have a link on the site under resources. It's been there for years, under the right side of the chart, support center. Going down to the bottom, tools of the trade, there is a link to the AAII sentiment survey. So you can pull the survey. They've just plotted it here with the chart. So here it is. Anyways, obviously this from the nature of this post, not a lot of words, this person's bullish and expecting a rally, stating that it's been it's only been this low 81 other weeks during the past 30 years, blah 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 blah. S&P rallied over the next 3 months after 77 out of those 80 something times. So we'll take a look at that, and again, you can see they put the little dots here when the sentiment survey reached this level. What that is, I'm sorry, if you're new to investing or trading, sentiment is a contrarian indicator, meaning when you have extreme bullishness, when a lot of people are very bullish, the market tends to drop, and that's because everybody's in. They've all got their money already, they're already bought, they're into the market. Their cash is usually deployed, and so therefore there's nothing left to do but to sell at that point. And likewise, when everybody gets bearish, that usually means that the last of the bulls have capitulated. I'll say this too, sentiment is less than worthless if you try to use it anywhere but extremes. It's all noise within there. So I've, over the years, try not to extrapolate anything but the most extreme readings. Even then, you can get some false signals, but the extremes are what help you point out. So when you're in the middle there, don't try to read too much of it. So there it is, and you can see they cite that there. You can look that person up on Twitter if you want to see more. Okay, so that's their take on it, and I can't argue these stats. And again, I've used the same things before. Drops to extreme sentiment readings, whether it's bullish or bear, or spikes up, to the top or the bottom of the trading range is what I'm trying to say. Let me pull my charts and I'll show you what I'm talking about. Okay, here's the AAII sentiment survey. This is called the bull bear ratio. So it shows you, I have it plotted here in a histogram format, but it's the same survey that the other person was referencing. AA, I think it's the American Association of Individual Investors. I believe that's the acronym for it. And what they do is they'll send out a survey. It goes out every week, and they poll the participants on as to whether they're bearish or bullish on the market, whatever the criteria is. What's your outlook for the next I don't know what it is. So let's just say month or so. You can look it up. Go to their site and they'll give you that information. But either way, again, if you reach these extreme readings, it can often mark tops and bottoms, or at least precede tops and bottoms in the market. And so here's a chart. I haven't even updated this chart, gosh, since this last time right here. Last time I posted it on the site that I recall, I know it was right here, before the big drop in January of 2018. That was the biggest correction by far in over 2 years. And this indicator, was one of several, actually many reasons why I was bearish. And you can see up top, I said this red zone shows extreme readings. So I have a line. It's that red line right there. Anything above the red line right here is my red zone. And you can see it's done a pretty good job. You get these extreme readings. I also use what I call clusters. Sometimes it's not a one and done. Sometimes you can see here's more of a cluster of readings above that level. There's a cluster. That's why I have these two lines together. It hit in this cluster here. You have these individual readings, but they're close enough together that I consider that a cluster as well. But each one had a little correction. This didn't result in much. You can see the market kept chugging along. Here we had a big cluster right here, and some really high readings, and that preceded, if you were around at the time, you'll remember, and if not, I can tell you, the market went sideways beyond the red. The red just shows the correction. That was, up to the point, the biggest correction, and many indexes had a bear market during that period, and it was almost a full 2 years before the market took out that high from right here. You can see down below, that was about 2 years of sideways trading where the market peaked out and had two big corrections within there. All of that was clearly foreshadowed by extreme bullish sentiment right there. So again, that's where it hits that level. You can look at all the other ones. And then the last time that I pointed out my red zone was hit was, again, right before the January drop. Odd enough, we haven't seen that kind of bullishness since. Now here's where I'm going to go. I'm going to take the other side of that individual. Now I can tell you they may very well prove to be right. We are in a bull market, and as long as you're in a bull market, that has been the MO. Like I always say, there's not any single indicator that's 100% effective. And as I often like to say, it's my own version of a yogiism. If you're familiar with Yogi Berra, who was a great Yankees player, pitcher or catcher, and went on to manage and coach a team. And he had the sayings, like one of his most famous is, "It ain't over till it's over," obviously. And so I like to say, in trading or investing, something works until it doesn't work anymore. And like, for example, buy the dip. You're in a bull market. you're a genius, because it works until it stops working. So I'm going to show you now a spin on that. So let's assume that we are in a great bull market. We already know we're in a great bull market. We already know we're in the longest bull market there's ever been in history. This is it. And if let's just say it just continues on. Let's, if you're the mindset, we've got another 6 to 12 months plus with, double-digit gains ahead of us, then you know what you just had, or I think maybe they said if you dip a little lower here, if it comes in lower, you'll hit. This is my buy zone. I don't know where, he had a different level there. So you can see the red levels. The last time my minimum, I have 2 buy levels here. You can see right here, it marked the bottom of that drop in 2015. This one nailed the lows right there in December 24th. And we're almost there now, but not quite. And then here's an extreme reading right here that it hit that level. Now, the reason I have 2 lines is over various market conditions you have to adapt. So that's point number 1 I want to bring up. So, I really dig down into charts, and and try to go back longer in time and see what is there, what might I be missing. And as I said a minute ago, something works until it doesn't work. The sentiment surveys, you need to look at what point of the market cycle you're in. So now we're going to go back here to the last bull market. Okay, this was the top in 2007. This whole thing here is the Great Recession, the Great Bear Market from October 2007 into the March 09 lows. The S&P and the NASDAQ fell over 55%. So that was a vicious bear market. Again, it doesn't look like much. It's not log scaling over here, so it might be a little distorted, but don't underestimate how big that drop was. Okay, so let's clear things out. And so let's see what happened back then. I could add more time to the chart, but we'll just go right up to this is several years before the top. So what happens, we had some extreme bullish sentiment, and there was a correction. Again, it might look like a little blip there, but that's a pretty big drop. When you're not using log scaling, and you drop, let's say, 300 points on a 1,000-point index right here, that's a 30% drop, right? You drop 300 points on a 3,000-point index like we are up here, that's only a 10% drop, 1/3. So it's going to look a lot smaller than a 10% drop up here. So that's what, if you're wondering why I like to use log scaling instead of, but you just don't have that option on some charting programs like this at stock charts when you overlay 2 charts. So that's that. All right, so there it is. So you got a correction, pretty healthy one, right? And then from there, what happened is you went on to hit, you got a buy signal here. Everybody got very bearish during that correction, right at the lows. You had one little trigger there, and then you followed up with another one, and that was a great time to go long, right, for the next ride up. Okay, so it's working, just like it's been working lately at that level. However, something different happened. You have to remember, we were several years into, that one started back in 2002, so we're 5 years or so into a bull market, which is average, used to be about 5.5%. This is going to skew the numbers now. So what happened is you had a sell signal warning. Everybody was getting too bullish again, and then another hit of that level, and that marked the top. That nailed the top right at the 2007 highs, right? Okay, so we corrected. Here's where I was going with things work until they don't work. So on the way down, you continue to do what you've always been doing, just like dip buyers buy the dips. They buy the dips until they finally start to realize at some point it's not a bull market anymore. Dip buying isn't working anymore. You're digging yourself deeper and deeper in a hole. It's a bull market in reverse. Instead of buying the dips, you should be selling the rips. And so what happens is these things stop working. And that's all I'm trying to say in this video, is you need to be aware of where we are in the market cycle. Now, we will only know in hindsight if a bear market is right around the corner, but if it is, my entire point to that tweet that went out and showing that everybody's getting real bearish now, and I've seen a lot of it on the site too. And by the way, I welcome that, guys. Put call ratios are high and all this stuff. And again, that if you believe in or it turns out to be this bull market has a lot more room to run, then yeah, there's going to be a lot of short covering and return back. There's too much bearish sentiment. If not, then get used to new lows, a range where you're not going to see, the bullish sentiment get so high anymore. You're in a bear market, and if you are, I'm sorry, if you are in a bear market, and then you can expect to see persistent and lower readings on the sentiment. People, if you think they're bearish now, let the market drop another 20%, you're going to see some big red bars. You're going to see what bearishness looks like, and you're going to see it over and over again. Once again, guys, if and when the bear market comes, it's more of a matter of when it comes. That is not up for debate. The bull and bear markets are as natural as the seasons. And we're going to get one. It's part of the business cycle, and it's just a matter of when it comes. So that's that. I've impressed the point. So again, this is just take everything with a grain of salt when you're looking at things that have been working. It's no different. By the way, guys, if you're trading let's say you have your favorite stock is in a price channel like this, whether it's a upward slope and downward or sideways price channel, and the MO, you start to see that the stock tends to reverse every time it hits the top of the range, and moves around and goes up again, might have some zigs and zags in between. So you say, oh, you recognize that. And this is technical analysis. So what do? You start going long at the bottom of the range, and then you sell your long position and or short it and ride it down to the bottom, and then reverse, wash, rinse, repeat. And you can do that all day long. That works until all of a sudden it doesn't work. And that's when you need to recognize that, hey, things have changed. And that's, I think, one of the most important things of technical analysis. And that's where trend investors get completely wiped out in bear markets, especially after a long one. We've been in this one for over 10 years. And what it does is those that are just, usually permanently bullish, because stocks do, yes, they most certainly do go up most of the time. But those that are, always been saying it's a bull market, buy the dip, don't short, it's going to take a while, quite a bit, for them to realize once we're in a bear market that strategy has no longer worked. We're not there yet, or who knows? Maybe we're only less than 3% off the highs in the S&P 500, so we certainly can't say with any degree of certainty that a bear market has started. You'll only be able to say that with certainty in hindsight. But the takeaway is just watch what happens. See what kind of reactions we start to get off these extreme readings. Like I said, here's one right there. That was the first quote unquote buy signal, and if you follow it down to where we just were, I was referring to this one right here. We were only right here in the process, somewhere in there, and it didn't work. And down here you got one, you had the first decent bear market rally, and then again you didn't get one until all the way down there, and that one did come down at the bottom, and finally, well, it was a very, very big extreme right there. All right, let's move on to a few more and we'll wrap it up. They're all going to pretty much tell you the same thing. Well, yes and no. I like to say this too, is when it comes to sentiment surveys, as I just told you a minute ago, if I'm let's say I'm one of the participants here in the AAII survey, I can check the box and tell them that I'm bullish. I think the market's going up over the next, 3 months, whatever the period is. But guess what? I don't have to have a penny in the market. Maybe I'm sitting on cash waiting for a dip to buy, or maybe I'm bullish in the stock market, but I'm more bullish on gold, so that's where all my money is. So you can be bullish in rhetoric, but not necessarily in positioning. So to keep that in mind with the AAII survey. The rest of these I'm going to show you do show with a couple caveats, but for the most part, people putting their money where their mouth is. Just like in the video, was it a screenshot, a chart I posted on the front page? No, I covered it in the video. The net long positions on futures contracts by fund managers, how that was at extreme levels. That's people putting their money where their mouth is. So that's actual positioning. There's no lying about those charts. That's shows you that there's a very crowded trade recently with net long positions on the index future. Okay, here's another one I like to use. This is the CPC. That's the CBOE options total put to call ratio, and that just takes throughout the entire stock market. It looks at the number of puts versus calls. A put is a bearish bet. When you buy a put, you're betting that the stock or an index will fall. You profit from that put if you buy a put, and whatever you buy the put on drops. So bearish on Apple, buy an Apple put. A call is a bullish bet that it'll go up. So Obviously, if the put to call ratio is very high, that is showing you excessive fear. People are buying a lot of puts overall, a lot more put buyers than call buyers. Likewise, when the ratio is very low, everybody's bullish. It means they're buying a lot more calls than puts. Very simple stuff. And again, now what I was saying about the caveat, it's not so straightforward because the professionals out there and most more experienced retail traders don't go buying just straight puts and calls. I can tell you guys, and that's why you don't see trade ideas coming from me on options. I've learned the hard way a long time ago. There are complex option strategy, and again, that's what the pros use, where you're using pairs trade. You're limiting your losses. But to buy outright calls and puts, I'm going to tell you guys from experience, you're going to lose money. I believe you'll lose just about everything you're doing in there if you're just, instead of buying, let's say you're bullish on Apple and you just buy a call on Apple, and then when you're bearish you buy puts. The reason is, what I like to say is, it's hard enough to get the call right on where a stock is heading to say that Apple's going to go from, let's say $100 to 120. It's a whole other magnitude of difficulty, another order of magnitude to not only get the call right where it's going, but when it's going to get there. And that's the problem with options. If I say Apple's going to 100 to 120, it could trade sideways for 2 years and then finally get there. And as long as I don't get stopped out with it dropping below 95 or wherever my stop is, hey, I was right. I wasn't wrong. It took me a lot longer to get there. But if I buy the call that's 3-6 months out, and it gets there just a day after that, or let's just say it doesn't pan out right away, the option is going to expire worthless. So that's again. So now what happens here is, a lot of this could be also institutions and individuals. When you see the put call ratio getting excessive, it doesn't mean they're just raw betting that on puts. They also may be hedging up their longs, but it's the same net effect. It just shows that fear, whether they're hedging existing long positions or they're placing just naked bets, trying to hit a home run because looking for a market crash. Because obviously, if you've traded puts and the allure, it's just like going to Vegas with the bells and the bright sound. Every time you win, you get excited. The endorphins come out. You trade puts, you're going to have 10,000% return. Sometimes you're going to hit one, your stock's going to move, and your put's going to go up 1,000, 2, 3, 4, 5,000, 10,000%. But then again, you're going to lose on the next 20 trades and whatever. I just won't go into that. I just tell you, if you're going to do options, read up on them, learn everything there is to know about them, and then consider using the more conservative paired trades that limit your losses. All right, enough on that. What am I looking at here? Excessive fear up top, excessive sell. You can see I put lines at the level, and right here, let me give a different color to this tool right here so we can see it a little better. Right here, you can see I'm boxing the bottom of the last bear market. There's that 55% drop. This is where the last bull market started, and we're still in it right now. All right, so I have that red line, and I'm going to circle every time that the CPC fell to that level without any exceptions. We've got 1, 2, this is a cluster. They're all close together, 3. And you can see, again, excessive bullishness. Without fail, it's captured. It didn't get this one, but it got up to that point. The 3 biggest drops in the stock market, bar none, didn't miss any of the big moves. So it's a pretty darn good indicator. And again, I say this all the time, if you like that and you're impressed, I don't use any of these as a standalone. This is not a timing indicator. In other words, you got your first signal there, but it took several months for the market. Although the market did flatten out, you wouldn't have been, had you shorted the market, as long as you didn't use puts, because it took a while, your puts would have probably expired. You didn't lose anything shorting. It just took a while after that third consecutive signal for that 15% or so drop to play out. And again, the drop was in the S&P. The NASDAQ dropped more than that. So there it is. So a pretty darn accurate indicator. And again, the takeaway more so is not, it's just to align it with other technicals. At the same point in time, I would have probably been looking for divergences, trendline breaks, support level breaks, everything else that I've talked about before, deterioration in internals back then, to confirm that. because the problem is you can go a lot deeper. And here's the other problem too, is like I said, something works until it doesn't work, and it's all about recognizing where you are in the market cycle, because during the last bear market, or this actually at this point in time, I should say, that wasn't even bear market, that was during the bull market run. So let me make that clear. It just wasn't working. So this is where you need to be adaptive on whatever you're using. If I'm using a certain moving average on a stock that has done a great job, let's say the 50-day moving average, every time the stock pulls back for 2-3 years, the stock bounced, and that's one of my buy indicators. But all of a sudden, I notice that it keeps going down below the 50. I keep getting stopped out. I go long again, I get stopped out. At that point, I realize, hey, whatever's gone on with this stock, it's not working. That method or that particular thing isn't working. Maybe I'll revisit it again during another market condition or other market conditions, and it might be working. But right here, it wasn't. So far, it has been, actually, it nailed that. Oh, guys, I missed one there. I showed you all the ones since the bull market started. That was the first drop to that level right after the bull market top. So again, all those red boxes it caught. And now flip it around. Here's the bullish thing. Here's my buy signal right here. And you can just take it down to the bottom. Here, we'll do that this way. Let me color this arrow. Let's make that blue. So there was a buy signal right there. Came right towards the bottom. There might have been a hair more downside. There was my next buy signal. These were all during the bull market. Didn't nail the bottom, but close to it. We went a little bit lower right there, but close enough to the bottom on that first drop. Right there, nailed the bottom, you can see. And I have the dotted lines there. I don't need to drag these down. All these dotted lines come in where these signals were firing, telling you we had excessive fear. Go long, go long, go long, go long. And I haven't had time to add that yet. That would have been right there. So, right, pretty good stuff. Right now, we don't have any cues, or clues, I should say, from this, because we're in no man's land. We're smack in the middle. The put-call ratio is going up, like I talked about earlier, and that others have mentioned on the site, but that's also typical before market top. Look what happened leading up. I have that blue line there as a 100-day moving average, simple moving average I put there. And so you can see the put-call ratio, in this case it was staying flat, but before all those big corrections, or most of them I should say, you had the put-call ratio going up. So where somebody trying to make a bullish case will say, oh, that's bullish because the put-call ratio is going up, it means there's a lot of fear in the market, and that's what I'm hearing now. Yes, and if we hit that extreme, and yes, if there's a lot more room to run in this bull market. Otherwise, this is more typical of pre-corrective or even bear market action. So that's how I interpret this one. And again, there's a lot of moving parts, and more so, you look at the fact again that we're 10 years plus, over 10 years into the longest bull market in history. So how much more upside is left? Sooner or later, you're going to see the excessive fear is not going to matter. You're going to get in a bear market, and these things aren't going to work anymore, in other words, as they have worked in the bull market. So you can replicate this one, use it as your own. There's a couple more I have, and we'll wrap this video up. This one is the CPCE. The E stands for equity. So it's the put to call ratio for equities. Equities are stocks. So it doesn't have your indexes in there, just stocks. Just GE, AT&T, Microsoft, Apple, but not the indexes. And so that kind of, because indexes, a lot of those, some people use those for hedging, whatever. It's just a different one to look at. And excuse me, what I've done here is a little bit different. Instead of having a line, well, I do have a line at the levels, my buy and sell levels. You can see right here, there's a green line. That is, green means buy. That's excessive fear. You want to buy when everyone's afraid. This is sell the market, go short, whatever, or at least confirm your other bearish analysis, because everybody is bullish at that point. So that's again what this is. When it's red, that's not bad. It means the market's strong. It just means nobody wants to buy puts. Everyone wants to buy calls. Everyone wants to be long. And again, pretty reliable stuff. We're just looking. Here's the start of the bull market was right here. You can see here. And so without fail, just like the other chart, I didn't use any exceptions. I didn't exclude any exceptions. Every time that we've hit and or crossed below that line has marked a major top in the market. You could have used this alone. Now the thing is, sometimes you hit it and you keep going lower. So again, as I said earlier, these are not exact timing indicators. Where you nail the entry or hone down on your entry and exits are the price charts, the divergences, 60-minute charts, daily charts, trend lines, support levels, price targets, all that good stuff. So you get a sell signal, but this puts you on a heads up or helps confirm too that, hey, you're at an extreme. So instead of maybe trading a little 2-3% pullback during a bull market, which might be all you can get during a strong trend, this is where you get those 5, 6, 10% plus corrections when you reach these extremes. So you can see all the arrows. You can pause this video and do it yourself, and without fail, every time it hit that level we had a correction, including that one back there in January 2018. Oddly enough, we never reached there. Just like the other indicators I'm showing, we're kind of in between no man's land here, and that's a lot like what happened. You can see leading up to the last bull market top. Remember, the bull market topped right here in October, late 2007, and we never really got down to that extreme either. So it's not a large sampling point. We're looking at just one, the end of one bear market or bull market in one full bear market, and then the next bull. But all I wanted to say is that again, this is really no different than what we were looking at back here. And let's see. So we had buy signal there. The buy signal there did not work. Oh no, it did. I'm sorry. Here's the arrows. They did. Those were good buy signals. All the green arrows worked. You can see this was a cluster too, right around the same level, and you can see each of these arrows. So without fail, those worked. Oh, here's what I wanted to tell you. That's right. I'm using on this. You can see these light gray lines. That's the actual CPCE. It can spike a lot on any given day. You have a big down day or whatever, you can see these spikes. And to me, there's a lot of, I'm not going to call them aberrations, but they're just extremes. So to tune out the noise, what I focus on, the red line, is a 20 period EMA right there, the red line. So that's what I'm using for the triggers. If that was confusing to any of you, that helps smooth out the bumps by using a 20 period EMA over the CPCE. And of course, if you have any questions, just drop me a line on the site. These kind of videos are subscriber only, so just drop something in the comments section and I'll get back to you to answer any questions. And here's just one more I'll show you. This one hasn't been really, I don't think, as effective and useful as the others. It's the CPCI, and that's the put to call, the index put to call ratios. So this is index put to calls, like the S&P 500, the Nasdaq 100. I don't. Maybe it has the Russell. I'm not sure if it has the small cap indexes in there or any others. But so you can see. Pretty much there's a line right here, and again, it's not as accurate, but you can look for these spikes. And again, sometimes when you have a lot of spikes together, I view that as a cluster. So you have this is bearish, this is complacency when you get down to that level, meaning everybody's bullish, and that's what tends to happen after a very strong run in a market. Everybody becomes bullish. They think that corrections will never happen again. Why should they? Everything's going up. Everything's great in the economy, great in the stock market. And that's where you get the lopsided, one-sided trade. When everybody's bullish, there's nobody else left to buy. Then you have a bunch of sellers, and then things happen pretty quick. So again, there were certainly some false signals there, and that's why I said this one doesn't stand out. It did, there were some signals that worked. There was the market top in January of 2018, right before the big drop. So you had to fire a signal there. And other than that, it's kind of been hit or miss. There was that was an important one back in late 2007. You can see just before the bottom fell out of the market. So just one I figured I'd share with you guys, and that's it. So the other ones are a little more important. And again, the takeaway from this, if nothing else, you probably, some of you I'm sure are familiar with some or all these indicators. It's just learn to recognize what market condition we're in, and then that way you may treat a certain extreme or buy or sell signal with a little bit of skepticism, or depending where we're at, you may use that to align it with other analysis. And of course, you should always align these signals with other analysis, because if back here, let's just say, for example, when these two fired, maybe there was not anything remotely close to a sell signal in the market at that time. Maybe the technicals were solid and bullish, and that's why, like I said, it's just something in your tool bag to use in conjunction with everything else. Okay, we'll wrap it up here. This has been Randy Finney with Right Side of the Chart. I hope you enjoyed it.